following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
From the floor of Bally's Convention Center at the Traders Expo 2011, Las Vegas, Nevada. This is Volatility Views. I am not Mark Longo. You can probably tell because
my voice isn't like this. Welcome to Volatility Views.
But no, this is your good old volatility reporter, Mark Sebastian. And with me today, we don't have Don. But I brought maybe the second or third best replacement, Bob Kraus from the Volatility Exchange.
Hey, good morning. Thank you for inviting me, Mark. It's great. This conference has been very well attended. There are thousands and thousands of people here. We've had lots of traffic at the booth, a lot of people very interested in volatility in general, but our product specifically.
And it was nice of you to bring your booth babe, Charlie Barwas.
Yeah, yeah, we need some hot babes in our booth. That's...
So, but yeah, we're really enjoying. I mean, it's been a great thing, and the Volx stand looks great, and just everything's great. And there he is, the booth babe himself.
Oh, stop.
But yeah, it's been great, and we decided to do the podcast from here because, hey, why not? So with that, let's roll out of our intro and into the Volatility Review.
It's time for the Volatility Review.
In the equity markets this week, it's been kind of a rough one on the equity markets. It has not been good. But it's actually, one of the interesting things is if you pull up VIX. The equity markets are off about, 40, 50 handles. And VIX is basically unchanged. Well, why is that happening?
Yeah, VIX is right now 32, 33.
Yeah, and where did it open on the week? It opened right around, I want to say 32-ish.
What day was that?
Monday. Typically the week starts on Monday.
No, I got that. What date? I don't have a Monday, Tuesday thing.
Oh, that was the 14th?
14th.
Yeah.
So the open was 30.04.
Yeah, so we're off 40 points, 40 or 50 points in the S&P, and the VIX is unchanged.
Essentially, yeah.
Yeah.
Up a little bit, very little.
Yeah, so if you were using, and the VIX is it's a good product. I'm not blasting the VIX. I really like it, but this is kind of the areas where sometimes it doesn't do the market the justice that it deserves. But I actually think if I was gonna, if you had to buy or sell the VIX here, since this isn't sold to you with Don Schlesinger,
right.
This is maybe we'll buy with Bob Kraus. Going into the weekend, you got the weekend decay out. SPOOs are basically unchanged. We got the super committee next week. Buy or sell?
I'm actually a very kind of a long-term bull on volatility right now. Yes, last week I think Don and Mark mentioned that, while they weren't convinced that, possibly, along with everybody else sort of lambasting these leveraged ETFs and ETNs, they thought that maybe that was causing volatility. I don't think leverage in and of itself causes volatility at all. Obviously at its extremes, excuse me, I really got tongue-tied.
No, well, that's a hard thing to say sometimes.
At its extremes, yes, leverage could be devastating or a problem, but leverage in and of itself isn't a problem. The S&P is leveraged, 10 to 1, 20 to 1 at times. It's not causing volatility just because we have leverage. Where the volatility, I think, is really coming from, if you talk to some of the fundamental traders in the market, they're looking at this stock market and they're saying it's a screaming buy. The indicators seem to be turning around. The companies are making profits. Then you go talk to the macro traders, hedge fund traders, who are looking at Europe and they're going, oh my God, this is a screaming sell. And so, the world could implode any minute. So,
we used to call it guys banging computers, is what we used to say.
Right. And so as soon as the market starts heading down, the macro guys pile in going, oh my God, this is it, this is the big one, and the market just tanks really fast. And then when we get a little bit of buying power, the fundamental guys start jumping in and they go, see, I told you, everything's going to be okay, and we start zooming up again. So I think volatility is here to stay for a while we deleverage the world and the economy, and that's not going to happen overnight. So I'm a long-term volatility bull.
Yeah, I know, and I agree with you. And if you look at, there's a lot out there. One of the things I've been looking at is that the U.S. economy seems to be a lot better than a lot of people think, and Europe's probably worse. And so you've got that kind of struggle going on where you're right. The fundamental guys look, hey, U.S. is recovering, and stocks are quote unquote cheap.
Right.
That's depends on your opinion.
Right.
But then you've got, the macro, the Europe thing that just scares the bananas out of anybody. And so, you've got that. And now we've got this Iran thing that's starting to run oil up.
Sure.
Yeah, West Texas is now trading over 100. Crack spread's starting to tighten up. But you've got West Texas over 100. Brent is still sky high. Brent is, people look at that West Texas, and they don't realize gasoline is mostly priced off of Brent. And so if you want to know why your gas prices are going up, look at Brent crude, not West Texas. But West Texas is more plastics, a lot of the other jet fuel, a lot of stuff like that comes from West Texas. So, there's this kind of, and the oil VIX is through the roof. But now, getting to Europe, and this is probably more in where Volux really kind of gets its teeth. What is going on with the euro? We've got Italy, we've got Portugal, we've got bond auctions going awful. We've got Greece is still Greece. What's going on? What's going on with the Euro Volux, the Euro FX VolContract, and what does realized volatility look like right now?
All right, so the index, we have an index, as you know, a 1 month, 3 month, and 12-month index on the euro, and over the last month it's been around 15. Last quarter it's been around 14, and the whole year it's been around 11 and a half. And 11 and a half is sort of normal, actually. 15's pretty high, and the latest P-vol, which is for the first 9 days in the December contract, is running around 15% as well. The inferred vol is 15 and a half, so we're approximately 50% higher in volatility terms than normal or average. Now that equates to pretty close to all-time highs. I think the highest 1 month period for the euro was around 20. So we're just a little shy of that. But, I think it could break open any day, but it could also just stabilize. If somehow they get together and say, everything's okay, and they put some Band-Aids on it, the euro could easily, drop to the 10% range. And, if all hell breaks loose, we could easily eclipse the 20%, I believe.
This is insane. You know what, Don, if we were standing here talking, what Don would be saying?
Sell.
Sold to you.
Right.
That's what Don would be saying. But yeah, so what do you think? We've got right now the active one vol is December.
Yeah, it settled at 1536 yesterday.
Wow. And how many days into the active? How many days have been passed in the December contract? And how much we're in our realized volatility period?
Right.
How much of that is inferred? How much of that is implied right now? And what's been the realized portion of that?
Okay, so we've had the partial vol, as I said, was around 15, and that's for the first 9 days of the contract. We have 15 to go. There are 24 trading days in the December version of the contract, and it's inferred volatility, which is very similar to implied, but it's not based on option prices. It's based on vol contract prices, and those prices are inferring 15.5 going forward.
And so, how would that thing get to? What kind of implosion would we need for that thing to get to back to 11.5? I mean, that's not plausible at this point, right?
Oh, sure, it'd be possible, but we're talking about essentially we're about a third of the way through, and at 15 already logged. So to get down to 11, we'd have to probably log something like 9 or so for
every
day from now till the end of December, which would be lower than average. Which, that'd
unlikely
be tough.
here.
That'd be hard. Yeah.
So you think 20 is more doable than probably? 20 may be more doable than. Can you imagine if we got to 20?
Well, in fact, just one crazy day could get you there. That's sort of the thing that you have to be very careful with when, selling volatility, is that one bad day could really skew the results, and so you got to be very careful, especially in this environment.
Yeah, because of the squaring function. If we drop 3% in a day, that'd be
immense.
That would be immense. So.
Right.
But that's why it's such a cool contract, in that you're trading kind of this anticipatory realized volatility idea. So, looking at stuff, let's leave out of the volatility review and let's go into the volatility view.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And this is the segment of the show where I'm going to kind of sit back and listen, and Bob's going to tell us everything that every brilliant thing that he's looking at and what he would do and how he would do it.
Well, this show I'd like to talk about what I think is for the long-term future of volatility and volatility of volatility. So let me explain a little bit. Let's suppose that. Or let me frame it this way. A lot of traders are saying that they're having a harder time making money in the markets. Well, is that because volatility is high? It just doesn't fit with a trend following system. Maybe the markets are getting more efficient. If the markets are getting more efficient, then it should be harder to make money, because then the price would be, quote, fair. Let's take it to its extreme. I think Don mentioned the term for that last time.
What was it? I know what you're talking about.
Yeah, something absurdum or something like that.
Yeah.
So let's take it to its extreme. What would a market look like if it was perfectly efficient? In my mind, it would look like a stair step. We would have some news. The market would instantaneously assess that news and jump or gap to the new level and start trading at that new level. And then it would stay perfectly level until some new news came out.
All right.
Okay? And then new news would be instantaneously reassessed by everybody perfectly, and it would jump or gap to another new level, and we start trading there until, again, some new news comes out. So we would have, essentially, instead of a trending market, instead of smooth curves and all that stuff, we would just get a bunch of stair steps, a bunch of gap moves. Mm-hmm. This wouldn't probably change volatility at all, but it would change volatility of volatility.
Yes.
Because of these gaps. And so I believe that, or let me go back. If you look at the volatility of the S&P over many, many, many years, sure, there are highs and lows, but as we all know, it's mean reverting, and there's kind of an average volatility of the S&P. And it doesn't matter if you look at it 100 years ago, or when they first started creating the index, or 30 years ago, or last year, the volatility is about average. And this year it's a little high, but next year it could be a little, and it averages to something in the 16% range, I think, as Don mentioned last time. But I believe that the vol of vol will increase with more efficiency in the market. That's because of this sort of gap, stair-step type pattern that I think we'll see as we get more and more efficient. So these day traders, algo firms, etc., they're not able to make money they're able to make money because the markets are inefficient. They're taking these little nickels and dimes, so to speak, out of the market, but they're making it more and more and more efficient all the time. And what I think you're going to see is more and more of these gaps and big moves when news comes out, and then sort of a stabilization after that, instead of these trending kind of markets that have been going on for years and years.
Yeah, that would be, well, the interesting thing is, in an environment like that, basically options kind of go away, right?
Oh, no, I wouldn't think at all.
They go binary, basically. You wouldn't have skew, you wouldn't have,
I think you would have skew, and Don and I kind of argue about this all the time. The article that they
all you'd have is straddle prices. There'd be no, I'm trying to imagine a world like that where basically, vol would be, you'd have a flat, I don't think you'd have skew, I think you'd have a flat vol curve. Well, vol goes away, right? The vol really comes in, but you've got these stair steps. I think you run a flat vol curve in an environment like that. So we go back to pre-87. I think you get rid of vol skew.
Well, Don's contention is that the skew is certainly overdone, and maybe it should be close or almost flat. And
I disagree with Don there.
Oh yeah,
Don, I love you. I love you, but I ardently disagree.
Well, and I kind of disagree. And in fact, I believe that the research that we saw last week that we talked about, I'm sorry, the gentleman's name escapes me, but he's from HSBC, the article in Futures Magazine. I think what the article really shows, now I'd like to see more research, obviously, but for my initial thoughts on this, I think what it shows is that the skew, the volatility smile, the smirk, so to speak, is too shallow. Because as we move down, and how he breaks it down, let me just refresh everybody's memory in case they didn't read the article or weren't around last show. Basically, what he did was compare two regimes. Instead of lumping all S&P moves into one big distribution pattern, he said, well, let's look at the distribution or the volatility when we're below the 100-day moving average, and let's look at the volatility when we're above the 100-day moving average. And so he just chopped it into two periods or two kinds of markets. He wanted to find out if we were essentially trending down, what kind of volatility you would expect. If we're trending up, what kind of volatility would you expect? And the conclusion was, and Mark Longo thought it was kind of surprising, Don didn't think it was surprising, but the conclusion was that even though volatility is low, let's say in the 10 to 15% range when we're going up, in fact, it's still too high. And you should be a seller of volatility generally at those when markets are rising. And
which I actually agree with that. That's right. And Don and I had some discussions on this,
yes,
where I think that guy misses the boat, and he does well. Where his argument kind of falls apart is that he looks at kind of the high vol markets and low vol markets, and his study really doesn't have the transitional periods.
Yeah.
And people don't blow up in low vol; they don't blow up in high vol. They blow up when we move from low to high.
Right.
And so, yes, it is. Oh, sorry. Yes, it is. That was me pounding the desk. Yes, it is overpriced, but it's it's also one of the most you can get caught.
Yeah,
that's
why that's a dangerous point. Yeah,
which is why there's
the inflection. Skew. Right. Well, maybe. But let's think of it this way. If we're below the 100-day moving average, well, then we've obviously moved down, right? And if we're down, he's saying that, volatility is higher.
Right.
So, when you're calculating the theoretical value of an option, regardless of whether it's in the money or at the money or out of the money, you're really calculating, well, am I going to get in the money? What's the probability of me being in the money? And so what he's saying is if the market's moving down, there's a higher probability of that thing going in the money because volatility now increases.
Right.
And so I believe that what it's... And then it also further went on to say that the implied volatility may be, even though it's much higher, may be a little too low. So what that...
I would agree with that.
Yeah. And so what it says to me is that I think the skew is actually not steep enough.
Well, and this is one of the when I was on the floor, the general rule was never get stuck what we call short the teeny.
Yeah.
You always want to hold, we call them on the option at Group 1, and we call them units. And it was these cheap options that I think are not priced properly. Because when the markets, and if you look at studies across the marketplace, the normal distribution doesn't work, all right? And here's why. Once you get beyond about 2 standard deviations, 2.5 standard deviations, we're going to 5. Right? Like the problem is the pricing model, normal distributions assume 3 standard deviations, 4 standard deviations. There's almost like this disconnect where it's 1 standard deviation, 2 standard deviations, and then we're dropping 80 handles on the S&P 500.
Right, and then there's 5, right?
And then there's 5.
That shows up in kurtosis. So what that is the fourth moment. So those that aren't familiar with statistics, so the first moment
is similar to fourth meal from Taco Bell?
Yeah, something like that.
Right.
Yeah, and that's interesting that you brought up Taco Bell because I saw the CEO on some CNBC news and they were saying, well, I heard that the meat content was less than half, and he goes, no, it's 60%. So
well, they sued him. They sued the.
So I don't know. Well, okay. So anyhow, talking about the moments of the distribution, the first moment is the mean. We need to figure out where the average or whatever is, and we know the mean is the current market, or the futures market, actually, to be more specific. And then the second moment is the volatility. That's the standard deviation. The third moment is the skew, and the skew of the distribution. And the fourth is the kurtosis. There are many more moments. We don't really deal with those, but the point is that the S&P or any market really is not exactly normally distributed. The S&P has a negative skew to it. It also has a positive kurtosis to it, or positive net kurtosis. So what that means is that the tails, or these large moves, can occur much more frequently than the normal distribution would say.
Oh, yeah. I mean, that's exactly right. And
the negative skew basically says those big moves seem to always happen on the downside.
Yeah.
Right.
Yeah. Well, and that's one of the things I always get in arguments with people is about closing option positions. And there's this effect. I like to call it the arsenic pill effect. Got that from Jeff Quinto.
Okay.
And imagine being short nickel and dime options is like playing this game. You've got a jar of jelly beans, and there's 100 jelly beans in that jar. And you pull out one and you eat it, and if you eat it, you get $10. But one of those jelly beans is made of arsenic.
Right.
That is why you are never short those. Is the $10? You know, in theory, you know, $10 is a lot of money to take that little challenge.
Right.
But the results of, you know, the 1 out of the 100 is pretty catastrophic. Let's just put it that way.
Well, absolutely. Nobody is, or there aren't any games where people are selling lottery tickets. You don't sell a lottery ticket to take in $1, and then if you lose, you know, it costs you $200 million or something.
Yeah.
You know, that's
right.
But that's what options are like. So you got to be very careful selling way out of the money options, because you're selling lottery tickets now. You know, yes, buying lottery tickets is a fool's game, but selling it is perhaps much more foolish.
Yeah, absolutely. Absolutely. See, there's a difference between selling insurance and selling lottery tickets.
Yeah.
You know, if you consider options as Alex Jacobson would call them, the cost of insurance, then, you know, those out of the money ones are just terrible idea, folks. So, but you know, and that's you know, so that's kind of that.
Okay.
So any other thoughts? Or with that, we will move on to our Volatility Interview. And welcome to the Volatility Interview. And this is the segment of the show where we bring on an industry expert in some sort of volatility product or volatility space to talk about what he does. And joining me and Bob today is Dan Cook from, he's the Director of Business Development, which is the DBD of the Nadex Exchange. And Dan, welcome.
Thank you very much.
So tell us a little bit about Nadex. How does it start? What is the concept behind it? And give everybody kind of the deets, if you will.
Certainly. Well, Nadex is short for the North American Derivatives Exchange, CFTC regulated futures exchange. The big difference is we really focus on the retail trader. So low cost of entry on all of our contracts are limited risk.
Okay.
And that's really the niche that we've started to succeed in.
And so is this a virtual exchange? Is it an actual exchange, or is it a product run through an exchange?
No, it is an actual exchange, CFTC regulated as a DCM, as well as a self-clearing organization, DCO.
Okay, where is it located?
It's located in Chicago, Illinois. So based right in the heart of the futures world.
Yes, as I say this over and over and over again. If you meet somebody and they're talking about trading and they're not from Chicago, not worth anything.
I appreciate that.
Or New York. Or New York,
yeah.
Yeah, but you know, anytime I see somebody, I'm in trading and I'm from Florida, I start getting worried.
And Dan, tell, in case I'm wrong, but I think it's very interesting for our listeners that they could actually just become not a member, well, maybe it is a member, but actually trade directly on your exchange without, opening a brokerage account or whatever. It's kind of like you just sign up on the website. Can you explain that?
Yeah, give us the whole process of how do you trade Nadex, how do you get involved in Nadex, and then why would somebody do that?
Definitely. Well, there's a few ways. It's very easy to start, and we're a little bit different from any other exchange. Typically, you have to open a brokerage account.
Right.
With Nadex, you can open directly with the exchange, as well as with PFG Best, who is an FCM and offering our products.
Okay.
But directly with the exchange is very easy. You can become a member for as little as $100.
Oh, wow.
So it's a very low barrier. We're really looking for that underserved retail type trader.
Do I get a badge if I become a member?
I can make you one up. It might be handwritten, but I'll send it to you personally.
Oh, nice.
So very easy. It's an online application process. It's an all-electronic exchange. We do have a proprietary front-end platform.
Okay. Did you build, and it's in-house built, or
it's in-house built platform?
And can you use other platforms, or do you have to use the Nadex platform?
Right now, it's either the Nadex platform, or if you open an account with PFG, they have it on their web platform.
Gotcha.
So we are actually looking to expand that as well. As we grow, there'll be more platforms available.
Mm-hmm. And now, it's retail based, but do you have member firms that are kind of involved in the exchange itself that are trading it?
We do. We have market makers that are basically prop trading for themselves. Yeah. But one of the interesting things is every member is their own market maker, so they don't just have to take the bid offer, and it is a true exchange. So we're not biased. We're not a brokerage house. We're not a shop that has a dealing desk per se. We're just there to facilitate the trade as an exchange is.
Right, and the exchange primarily deals in binary options, correct?
Binary options is our major product.
Yeah, so talk about how, so if I bought in, would I actually use the Nadex platform to stream quotes if I wanted to be a market maker, or would I, how does that process work? Because this is really interesting.
Right, with every member is a market maker, so they could use our front end. Now, a professional market maker probably has their own algorithm, their own set of different things that are running.
Right.
So that's
could I run like a joiner script or something like that if I wanted to?
If you're comfortable with the risk,
right,
you can run basically whatever you want.
Right.
One of the things as well that we're different. We're a retail exchange, so we're not interested in getting into a latency war. Like high frequency trading, so we don't allow anybody to cross connect or co-locate with us, except for market makers that are obligated to make double-sided markets.
Okay, that's nice.
Yeah, so the retail traders.
I wish some of the other exchanges would do that.
Well, we've seen a lot of the May 6th flash crash, different things, and we don't really know the cause, but yeah, we're not into latency war. We are a retail exchange, and that's where we want to stay. Gotcha.
So tell us about. Why don't you talk a little bit about what is binary option? And what's the concept behind it, and why would somebody trade a binary versus a traditionally listed exchange option?
Well, with a binary option, it's essentially a true-false statement. It either settles at 0 or 100. If it's false, so a statement maybe Euro USD greater than 135. Does that happen or not? If it doesn't, it's 0. If it does, it's 100. Now
it doesn't matter if it goes to 40, 140, or 2,000. It's in. It's above 135.
Exactly. If it's 0.1 tick above, then it's above, and it settles at 100. Where it's interesting, though, you could look at the price as a probability. What's the probability of that event happening? So as the market moves, the price of the binary option will shift.
So it's like it's a really different kind of delta.
It really is. You can actually have exponential delta. Because keep in mind, at expiration, where you have traditional option, you might have negative 1 to 1.
Right.
A binary option, the difference between the flat 135 and the 135.001 is the difference between 0 and 100.
Right.
So they don't have to move in linearity. So delta, we call it exponential delta exploding gamma.
Right, exploding gamma. Yeah, no kidding.
Exactly.
That is incredibly exploding gamma. Now, is the contract set up European? Can you give us just a few specifics on the contract itself?
Definitely. All binary options contracts on Nadex are a $100 contract. They're fully collateralized. So if I'm buying at 20 and you're selling to me at 20, I have 20 points risk, so I put up $20. You have 80 points risk, 20 to 100. You put up 80. Fully collateralized trade, so you can't lose more than you have in your account.
Right.
You can have effective leverage without all the negative downside of possibly losing your home.
Right.
Which is a nice thing. But you can actively trade in and out. You don't have to hold them till expiration.
Right.
So if I buy a binary at 10, I could sell it at 40.
Right.
If the nature of a binary, if it hits at the money, it's got to trade about 50-50.
Right.
So maybe a 48.
And the nature of the contract is that it's a European option, I would assume.
Yes.
I mean, can you imagine a binary option that was American style?
I can't.
That would be hilarious. That's what I'm going to do. I'm going to start an American style. I'm going to be the sole market maker on a American style.
I think you'd be the only market maker. Definitely. It is European style, but and particularly for the retail trader, because it is limited risk. For volatile times, when we're talking about volatility, I don't have to worry about, hey, I put my trade on and I margined at 20 to 1 or 50 to 1, and I had 3,000 this morning and now I owed my broker 2,000.
Right.
It can't happen because all the money's put up front.
Right. Gotcha. So
in a way, trading just a simple binary option is almost trading volatility in a way, isn't it?
It really is, and it's a way to do it with limited risk. Around a fundamental news announcement. Let's just use some round numbers. I might trade 2 binary options. If the market's at 100, I have a 90, which is in the money. Mm-hmm. So maybe I sell that at 90. I can buy the 110 maybe at 10 points. So on both sides, I just have 20 points risk, but I have a lot of upside. I can basically spread or put a range around the market. I don't care which direction it heads. I'm just looking for it to move. And as we've seen in the markets, we've got plenty of movement.
Right, absolutely.
Yeah, so very, very simple strategies.
So in other words, so one just having one binary option, let's say 100, and it's 100, you got a 50-50 chance being in or out. But if you could actually do sort of 2 of them and make kind of almost like a straddle in a way, right? So what you're saying is you're going to do a little bit out of the money and a little bit bit out of the money both ways, right?
Correct. Well,
So how does I'm not clear. How does that work again? So we're going to do 2 binary options now. You know, we're the current market's at 100,
right?
And we want to do the 90, 110. So what do we buy and sell there?
So essentially the 90, because the underlying market's over it, is going to be priced. The probability is greater. It's going to expire in the money. So maybe we have a price of 90. We could sell that one. So if the market takes a drop down below the 90, it's going to settle. On the other side of that, since we don't really care which direction the market is, we have the 110 that might be priced at 10 points that we can buy. So we're just looking for the market to make a move and one side to actually either end in the money if we're on the buy side or out of the money on the sell side.
That's interesting. What is now? I don't know what does the vol structure ended up looking like of the different contracts. Like, you know, coming from an option world, I'm thinking about how a vol skew would look on binary options up and down a curve, and I would think that it would have a really unique structure to it.
It does, and typically there's just a general rule of thumb. On the volatility, during times of greater volatility, you'll see prices tend to move towards the center. So if you have a great deal of volatility, instead of maybe being priced at 90 if it's well in the money, it might be priced at 85 or 80. And so you tend to see prices migrate towards the center. And a lot more strike prices become active.
That's cool.
When there's high volatility.
Yeah, that's cool.
There's always we typically price 21 on each underlying market, 21 strikes. And so you'll typically have quite a few in place, so you can really hone where your risk reward, what you want to do for your entry.
That's kind of interesting, and it brings up a point which I've often, thought of. It's this absurdum thing again, which I forgot the name. But to its extreme, let's suppose volatility is 1,000%. The market's just like, nobody
every
knows
binary
where.
Option would trade 50, right?
Right. Nobody knows where the hell the center is because, one ticks down, 200 points lower, or the next ticks 300 points higher. Nobody knows what the middle is, so everything is essentially in the middle now, So when volatility just explodes, then, nobody knows exactly what the middle means anymore. So the best guess is really just to trade it at 50-50.
Yeah, and we'll, with the strike prices, because they are set up pretty wide ranges to cover, if we have a 200-point move in the Dow, we've got that covered with the various series. So you'll see
there's some really unique things. I'm just thinking as a market maker, there'd be some like really weird things, like you would never do a 1x2 bet. You'd never do a 1x2, right? I'm trying to think of a scenario where you'd want to do something like that, and because you don't get the stretch payout, so you're going to want to structure things like you said, like the straddles and call spreads and different things like that. But
yeah, it's the market maker. They're obviously looking at the vol skew.
Yeah.
How am I pricing this? Where is it at? Because in volatile times, that's why we see a move to the center.
Yeah.
But they're really looking for flow.
Yeah.
They want to get both sides of it.
Right.
So I've never been a market maker, so I can only kind of estimate what they do. But that's the basic principle.
Great.
Thank you so much, Dan.
Yeah, Dan, thanks for joining the show. And you want to give people, how do people find Nadex?
Definitely. The easiest way is to go to www.nadex.com. All of our contact information is there.
And thanks for joining the show. And with that was the interview segment. And we're going to go right into our Volatility Crystal Ball.
And now we take a look at the crystal ball.
And welcome to the Volatility Crystal Ball. This is the segment of the show where I make random stabs at what might happen in the near future. And Bob uses his cerebral cyborg-like brain to properly analyze what's coming up in the near term and give us some prognostications of what may or may not happen.
Okay.
So.
All right, I'll do my best.
All right. Well, on my end, when I look at what's starting with the S&Ps, when I look at what's going on, I see kind of the idea of a meltdown is starting to develop in my head. So, in a meltdown, what you have is you have the market falling and volatility falling at the same time, and that is a trader's worst nightmare. And, implied volatility.
Yeah.
I mean, because, with the VIX at 33, we need the market to move 2% a day to pay for a VIX at 33%.
Right. So what you're saying is, in other words, for volatility to go down, or this meltdown scenario, is for us to go down slowly?
Yeah, 10. I'm saying 10 to 12 handles.
Yeah.
10. Even if we move down 15 handles a day.
Yeah, that's still not enough.
So it doesn't.
Yeah.
It's not enough for VIX.
Right.
So I see a scenario where we kind of creep down to in between 1150 and 1175, probably into the 23rd meeting, and the VIX is unchanged or maybe even down. And that's kind of what I'm looking at in terms of the euro. I continue to be bearish, and if Don wants to sell me that vol contract, I might say buy him. I might. At 15, that'd be kind of rough. But if I see that Volex contract drop toward 14, in the near term, anywhere near, Don and I were talking about this, anytime we've gotten anywhere near the long-term mean, the vol contract has been a screaming buy.
Yes.
So if we see the vol contract fall anywhere below probably 13%, I would probably be looking to get long FX vol.
Yeah, I mean I would have to probably agree with that. It's a little tough at 15 to kind of swallow. It's such a high number in relation to historical norms for sure.
And unfortunately, that is going to do it for this episode of Volatility Views. I want to thank both Mark Sebastian and Bob Kraus for valiantly diving into the breach for us and recording live from the Traders Expo there in Las Vegas. Due to an equipment error, we're not going to hear Bob's final thoughts on volatility, but sometimes that happens when you're recording live in the field. I want to thank all of our listeners out there for downloading and streaming and subscribing to the show and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.